Welcome to the Industry Experts Panel at PortfolioWealthGlobal.com. My name is Michelle Holliday. Today, we are welcoming back to the show Mr. David Hunter. David is an investment professional and a precious metals expert. He is the chief macro strategist at Contrarian Macro Advisors. David is widely known and he has a stellar reputation as an independent thinker when it comes to finance and to wealth. We are honored to have him on the show today as we are watching what some are calling the very beginning of a silver short squeeze, while others are saying that it is all over. So we are calling upon our resident contrarian to add to his perspective on what is truly happening within the markets. David, welcome back to the show. How are you today?
I'm good, Michelle. Thanks for having me on.
I love having you here. Your perspectives every time are really interesting because you tend to go the opposite direction of everyone. And most of the time you're right, which is incredible. Well, everybody else is sitting there looking at you like you're crazy. 4 months later, they're saying, hey, David called it. Right now, the precious metals markets are hot. So let's start there. You have talked about the secular bull market that you have predicted will be accelerating over the next several months. And then you see a future bear market that you see coming, which could be steep. So I want to start right there, David. First of all, when we're talking about the silver short squeeze, did it have any effect upon your predictions that you've made over the last 6 months or so?
Yeah, actually, not at all. In fact, in the past week, when you were seeing all over Twitter people taking on the handle silver squeeze, I said, if I see that one more time, I'm going to start blocking people. So I just felt it was hype, but certainly, in the short run, there's the narrative out there that the ETFs, the silver ETFs, have a lot of paper and they don't really have the silver to back it. So there's talk about that. There is a situation going on with Basel III where they're going to start telling the banks to get their silver holdings up. So there are, I guess you could say, there are potential squeezes there, but in terms of Reddit and what they could do to squeeze the shorts, I don't think that's real. But yeah, I am very bullish silver. So whatever drives it, it's going up, in my opinion.
Everything's good with you. Now, let's define for everyone, David, what a secular bull market is, first of all.
Okay. Yeah, I'm going to step back because I am a secular bull on the stock market, or believe we're in a secular bull, but coming to the end of a secular bull. So when in my letters and on Twitter, when I talk about secular bull, it's usually in reference to the broader stock market, because I think we are in the 39th year of a secular bull market that started back in August of 1982 for the stock market. Silver and gold are in their own cycles, and I'm very bullish both of those. But in terms of when I am talking secular, I'm really referring to the broader stock market. And to differentiate a secular bull from a cyclical bull, a secular bull contains many cyclical bulls. So each cycle, each economic cycle, there's usually a bull market in the equity market to go with it. And a secular bull will contain several of those economic cycles and several of those cyclical stock market bull cycles. And so we've had since 1982 several economic upswings and then recessions, and we've had several stock market upswings in that period, or cyclical bull markets. We are coming to the end of both a cyclical bull market and what I believe is a secular bull market. So we're in the latter stages. I have been known to be talking about a melt up here because the latter stages of a secular bull typically go parabolic. And that's what we're seeing here is the market just keeps going higher and higher, and people go, this doesn't make sense to me. Well, it does if you really step back and understand where you are in a full cycle. In terms of silver and gold, I think we're not coming to an end of a secular bull. I think that runs all the way through the decade. So there's plenty of runway ahead in terms of silver and gold. Stock market, not so much.
Wow. Before we leave the topic of precious metals, first of all, I want to talk about the impact of the inflation that you see coming upon the precious metals markets specifically. And talk to us about numbers. Where do you see this going, David?
Sure. So in the short run, I think we are seeing a bit of a burst in inflation, breakout from a very long downtrend. So I do see over the next several months the odds that we're going to see higher inflation and probably push up against 3%, maybe a little higher. And then I'm calling for a global deflationary bust to begin sometime later this year. So that will take inflation back down into negative territory. So I don't think this is a sustainable inflation move. The one we have now is just a short-term move. However, once we get beyond the global deflationary bust, on the other side of that, we'll have a recovery cycle that I think is going to be industrially driven and inflation driven. And it'll be the first inflation cycle we've seen since the 1970s. In that, the inflation could get up to 15, 20% or higher. So we're going to go from negative inflation or deflation in the next year to potentially 20% plus inflation by the end of the decade, in my opinion. So it'll be something we haven't witnessed in the last 40 years. We peaked out in inflation back in the early 1980s at somewhere around 20%. And I think this will be a full retrace at that.
Wow, this is really interesting in terms of investing. Your forecasts are just spectacular because you can almost guide your investments based upon your forecasts themselves. Now, I want you to go into that a little bit more, please, for us. What kind of breakdown are we looking at deflationary wise, and what are your best suggestions for the next 10 years?
Sure. So the global deflationary bust is really driven by the fact that we've got so much leverage in the system. We've spent the last many decades really building up debt in the system, not only here in the United States, but around the world. So that global debt right now is in excess of $250 trillion. And then on top of that, another form of leverage is a leverage of derivatives. They leverage up financial markets. So you've got two kinds of leverage that are basically at unprecedented levels. Nothing even close to these levels have ever been seen before in the world. And so if you get into a situation where you are beginning a downturn, that leverage will accelerate that downturn and exacerbate that downturn. And that's what I think we'll see later this year. For a couple of reasons, I'm not a real fan of real estate going forward. I think probably for the next few months, next several months, it still continues to, on the housing side, continues strong. But a deflationary bust will take most assets down, and down hard. So, stocks are going to go down. I have an 80% bear market prediction out there. Even gold and silver will have a backup. They won't be nearly as negative as the stock market. But real estate will get hit along with most assets. And then on the other side of the bust, in the next recovery, if in fact inflation is going to head towards 20%, that means interest rates are going to be heading towards double digits. It won't happen immediately. The first couple of years out of the bust will probably be very gradual increase in inflation and interest rates. So you'll still be in, maybe mid single digits. But the problem is, as rates move towards double digits, that means mortgage rates move towards double digits. That means people's, when they typically buy a house today, they're looking at how much can I afford? And the affordability is really very much not only the price of the house, but what's my mortgage rate? What's my mortgage payment going to be? And so if you're going to see double-digit mortgage rates somewhere out in the middle of the next of this decade, that's going to be a huge headwind for real estate and put a real damper on prices. So I tell people who normally think of real estate as an inflation hedge that I don't think it's going to be much of an inflation hedge in the next cycle because of the rapid rise in rates that I see coming. So, if you have a home, you need a home. I'm not certainly out here saying people shouldn't own their homes. But in terms of speculating in real estate, I think it's probably not going to be the best cycle for it.
What do you think is going to be hot? Where's the best place to be?
Well, I always tell people I'm a strategist. I'm not a registered investment advisor, so I cannot give advice. I can't provide investment guidance. I can forecast. So by my forecast, you can tell I think gold and silver are going to have a huge cycle ahead. So this year, my forecast for gold is 2,500. For silver is somewhere between 45 and 50. And I think we could see those prices in the first half of this year. For the balance of the decade, somewhere out late in the decade, I think you could see gold north of 10,000 and silver north of 300. So they have huge runways ahead. But I also caution people, there's that deflationary bust in between. So you have to be careful not to be a straight line thinker, a linear thinker here, and think I don't have anything to worry about, because as an analogy, I say, if you're standing on the south rim of the Grand Canyon and you're looking across to the north rim and thinking you can just walk straight across, you're in for a shock. There's this thing called the Grand Canyon in between. Well, it's the same thing with gold and silver. If you own it today on the basis that it's going to be 10,000 and 300, 7 or 8 years from now, understand there's a big canyon between here and say 2022 or 3 that could take them back down 30%. So you have to be, some people may want to own it and just hold it right through that. That's their choice. I'm just saying, don't be unaware of the fact that there's a trough in between, or a correction in between.
Okay, so according to your forecast, buying the dip might be a great thing because you're expecting it to go down before it starts to go up.
Yeah, I'm not, like I said, I can't give any advice. So people have to figure that out on their own in terms of what their risk profiles are. Some would rather kind of just average in or buy gradually, and others might want to try to time it. It's an individual choice.
Okay. Now I want to ask you a question. Your forecasts, as I mentioned at the top of the show, you are, of course, a contrarian, so you tend to go the opposite of the crowd. And you're doing it based upon the exact same data that other economic forecasters are using, which I find very interesting. So when you're looking at the economic landscape to determine what you see, what is your strategy upon reading the data that brings you to your conclusions?
Sure. Obviously, different people have different forecasts of the economy, different opinions on where it's going. So that's 47 years of doing this, I feel pretty comfortable with my abilities to forecast the economy. But in terms of forecasting markets, you have to take into account the fact that markets are discount functions, so that they discount the future. And you have to kind of decide, or through analysis, determine what's being factored into the prices right now. Not only what do I think the economy is going to do, but really what's sentiment. So as I say, I use technical analysis, I use fundamental analysis, I use macro analysis and cross-market analysis. But then probably the very big differentiator is I look at sentiment. And for example, last March, when the market fell so dramatically, over 30% in 3 weeks, everybody got bearish. And I looked at the sentiment, and it was at levels that it rarely gets to. So I said, this is a fake out. This isn't the real bear market. The bear market's out in the future. And I got very bullish. And I also knew that, the Federal Reserve was going to come in with both feet because they told us they were going to. And so you had this huge liquidity surge along with fiscal expansion that helped provide a wind at your back. So, every cycle is different, but that's kind of what drove my work back last March.
Where are we right now in terms of the overall markets? When you see the big picture, talk to us about it.
Sure. Yeah, I think, as I said before, I think we're in the late stages of a 38, almost 39-year bull market, secular bull market. And I think that's going to come to an end potentially in the first half of this year. When you're talking about 39 years, it's hard to pinpoint and know, I could be wrong and it might stretch out for, several more months beyond that. But at least right now, my best guess would be that we're going to see a top in the secular bull market in the first half of this year. And I think it's going to end in a parabolic. We're basically in that parabolic now. That means the market just keeps going up and up and up. And you get any pullbacks are very short and sharp. I have a target out there for the S&P. I just raised it in the last week. My target is 4,600, and I think we'll be there in a matter of months. My target on the NASDAQ is 17,000, and again, similar timing. And the Dow Jones, I think, can get to 37,000. And I'm not sure I'm even optimistic enough. I mean, it may be that I'm still a little too conservative. I think we're close to the end, but when you're in that parabolic, it can go wherever it wants to go. So if it wants to overshoot by a couple hundred points on the S&P, it could very well do that. But, best I can tell, it's somewhere in that ballpark.
So you see the last half of the year economically very different than the first half.
Yeah, it's funny because, as you know, the street probably thinks the second half is where you're going to have the strength. And I actually think, I'm not sure whether it's third quarter or fourth quarter, but I think somewhere in the second half, the economy starts really running into trouble. I think second quarter is going to be strong. I think third quarter may be relatively strong because of the vaccine and economy opening up. But I also think because of that inflation surge we're getting, ultimately the Fed, it may have to lean against the winds here. If you see the stock market up around 4,600 on the S&P, and you see inflation pushing 3%, and you see people, taking on risks like junk bonds and things, which we're seeing right now, where they're pushing those to the highs. I think at some point the Fed's going to say, "Hey, maybe we overdid this. Now the economy is opening up, we have to worry that we're pouring too much fuel on this fire." And I think you could actually see the Fed tighten towards the middle of the year. And if you see that, that's probably a signal that the stock market's going to start running into trouble. Now, keep in mind, the stock market will lead, typically anyway, it leads the economy. So you could have the top in the stock market in the second quarter and have the economy strong into until you get to the fourth quarter. So it doesn't mean the bust starts immediately when the stock market rolls over. The stock market may roll over on the basis of tightening, and yet the economy may still have legs until you get into the fourth quarter. That I can't tell.
Talk to us about the bust. Talk to us about what does that look like?
Yeah, I coined the phrase global deflationary bust. Putting those three words together, they're three words that are used all the time, but putting them together several years ago, I said, when this cycle ends, it will end in a global deflationary bust. Again, we haven't had a deflationary downturn since the Great Depression, so that was 80 plus years ago. And we're not about to have another drawn out depression here. So I define bust as something that's got the magnitude of a depression in some ways, but happens at the speed of a recession, or even faster sometimes. So you could have all the damage done to the economy contained within a year, but it could be the most damage we've seen in since the Great Depression. So it'll be very fast. In other words, or relatively fast, but very steep. And part of it, as I say, the bust really started last March with the pandemic, because we shut down the economy. The economy dropped on an annual basis more than 30%. That's pretty much a definition of a bust. So we had that in the second quarter, but then we had this, massive liquidity pump, not only here, but around the world. And so then your third quarter was up 33% on an annualized basis. So you had the first step of the bust in the second quarter, but then, because of fiscal and monetary stimulus and relief, you were able to kind of postpone any further bust. So I call what's coming later this year the second shoe dropping on the bust, or second stage of the bust. It's not a new bust. It's all part of the same thing. The pandemic really was the trigger. The massive debt and the massive leverage is really the reason it won't be a recession. It'll be a bust. And then, sometime probably middle of next year, you begin recovery, and that recovery will carry you into, the latter half of this decade.
Great. So it's not a long drawn out. I don't want to be like, oh, that's great, but at least it's not a drawn out situation. So if you can make it through and you can be prepared for it, things could be good at the other side of it.
Yeah, that's the good news is it's not a decade long depression like we saw in the 30s. The bad news is it will feel a lot longer than it is while we're going through it, just like this pandemic's felt long. When you add to the pandemic, a surge in bankruptcies, I think we're going to have a big involuntary debt liquidation cycle where both on the corporate side and on the individual side, you're going to see a lot of bankruptcies and some major bank failures around the world. While you're going through it, you're going to be worried about, is this, when are we ever going to see a recovery? So a year can feel like an eternity when it's pretty negative, and that's what I think we're going to have. But yes, the good news is because of what the Fed and central banks around the world, as well as the governments, will be doing, we will have a recovery probably within a year of the start of the bust, and maybe sooner than that. So.
Great. You know what, David, I want to get your thoughts on green technology and artificial intelligence and the new cutting edge tech that's coming out very probably within this decade, if not the next few years. What kind of economic impact globally would that have? Sure.
Well, you're talking to a 69-year-old dinosaur, so there's probably better people to opine on this. But I will say on the green energy, it's coming. I mean, there's no question that obviously a Biden administration is going to push it harder than the Trump administration would have. And there's certainly around the world, a lot of a desire for it. So it's coming. But I don't think it's coming nearly as fast as, the rhetoric has you believe, because we just can't replace fossil fuels with alternative energy that fast. So yes, we'll have electric cars. Yes, we'll have alternative energy, but you're still going to have an economy driven with fossil fuels as the dominant fuel for at least this decade into the next decade. So I think people need to kind of put the brakes on a little bit with what green energy is and what it can do. It just can't. There's no way they can replace the demand for energy that we're going to have coming up in the next recovery. And by the way, as I said, it's going to be the first industrial recovery since the 70s. And so, all our cycles since, 82 have been consumer driven. Well, I think what we're going to see in the 2022 to 2030 period is an industrial driven cycle. And that demands a lot more energy. You can have factories, operating at higher capacities than they have in the last 30 or 40 years. You're going to have a lot of infrastructure building and a lot of demand for commodities. So energy is going to have to still rely on oil and gas. And so I'm a big bull on oil and gas in the next cycle. Doesn't mean you won't have growth in the green energy. You certainly are going to. That could be, a very big rewarding area for investors. That's not where I'm focused, but I would just caution people. We're not going 70-80% green energy anytime soon. And the politicians like to push it. It works, but in reality, it's something that evolves. It's not a revolution. It's going to happen overnight. In terms of artificial intelligence, again, I'm not an expert there at all. All I'll say is it's certainly an area that is getting a lot of attention and a lot of capital. And so you can only assume it's going to be a big growth engine for the next cycle.
David, what are your thoughts about cryptos?
My thoughts are pretty much non-thoughts. As I tell people, I don't follow it. I have no plans to follow it. It's not necessarily that I'm negative on it, but I am skeptical because it has not been through one cycle yet. It's kind of got a cult-like following, very much a momentum investment at this point. So, very momentum driven. Those aren't great characteristics for, longevity. So I'd like to see how it holds up in the bust. And I am concerned, again, I'm not an expert. I don't follow it at all, but it does seem like, unlike gold or silver that have finite supplies, this is something where it's somewhat of a contrived supply-demand story, in my opinion, and it does seem that it's gained a lot of its following because of all the skepticism over institutions. There's people are pretty negative on the Fed and central banks in general, pretty negative on governments and how they control our lives, and so Bitcoin feels like, hey, here's a way around that, and so that's kind of driven the narrative, and I'm just not sure it has that kind of staying power, and you do governments could certainly impact its future. So I think for all those reasons, I would just caution people that it's not a given. It's not something that you're going to have a lot of people pumping it and pushing it and telling you because it's had a great run, certainly in the last 6 months. And I just am somewhat leery of something that's driven more by momentum than anything else.
Yeah, a lot of talk there. When you spoke about the AI and the green revolution, and even though I do believe they are coming, I don't think it's nearly as fast. I totally understand what you're saying, but it brought up the cryptos in my mind because that seems to be, cryptos, everybody seems to run, anytime anybody says this is hot, everybody runs in that direction, and then this is hot, runs in that direction. A lot of running around going on. I
just remind people, not that crypto is in this category, but I just remind people GameStop was $400 a week ago. It's now $49. So, I mean, momentum attracts momentum, but it also works in both directions.
Right. So you can make a lot of money, but just be careful.
You can make a lot of money in momentum. You can lose a lot of money in momentum. So,
exactly. David, let's talk about employment. In this kind of economic atmosphere, what is your perspective on the current jobs market? Where do you see the opportunities developing from, and what would be your best advice?
Okay, yeah. If you're talking about young people and career planning, I tell people, I get a lot of this on Twitter. People will direct message me and say, "Can you tell me what books I should read so I can do what you do the way you do it?" So I go, well, this really built up over 47 years of experience, and I did a lot of reading early on in my career and all of that, but it's some of it's God given, some of it's experience, and some of it's book learning. But it's not something where there's a formula to it, or there's lots of people that have been around 40 years that still don't forecast very well. So it's not all that. But so I'll tell people, don't everybody wants to jump into, or the people that contact me want to jump into the financial markets and into becoming an investment guru or what have you. I said the future for finance is not as bright as you might think. If we're running into a world where you have a global bust and then you have hyperinflation, and what may come after that hyperinflation may not be very pretty. It may be more drawn out and very troublesome. We've had basically 40 years of building what I call a Ponzi scheme. With all the leverage in the system, that Ponzi scheme at some point is going to really break apart. And so I'm not sure finance is the future. Always go with what you love. If you're really a numbers person, you really love this. I don't want to discourage people. There's still going to be a place for people in finance, but it's not going to be the kind of landscape we've had of late. And if I were 20 years old today and looking out, or maybe 18 and looking out, I think I'd go to Colorado School of Mines and become an engineer in the mining field, because I think if we're going to have 20% inflation rates in the next decade, and it's going to be driven by commodities, and particularly precious metals are going to do as well as I think they're going to do. There's going to be a huge demand for people in the mining industry in terms of engineers and people that can find what is going to be a much harder thing to mine. The easy mining has taken place. As the price moves up, you'll be able to justify mining that's not as concentrated, et cetera. But I'm far from an engineer myself, but that's where I think there's going to be some future. And again, technology of all kinds is going to continue to grow. It's just amazing the kind of progress we are making in terms of technological improvements and changes. So but probably the biggest advice I just gave to somebody today. He was wondering where to steer his daughter and thinking finance, and I said, tell her to figure out what she loves to do and focus on that. Don't try to steer her. If she loves science, let her choose something in that direction, or math, something in that direction. If she loves English, go in that direction. But don't think it's let's figure out where we can make money and go where your heart is, and I think your success will follow.
Right. Your instincts will tell you where you should be headed, and that'll guide you along. Now, in closing, so your thoughts about, we've been hit with the pandemic, and we've been hit with, all the economic shutdowns and all of this. So you don't see this as hugely impactful upon the forecast that you've had and held over the last several years. That's what I'm hearing here. You don't seem to have hugely changed because of this impact. So do you think that the pandemic is short-lived and will just sort of ride along the crash that you see coming, and then out of it that you see coming?
Yeah, I guess I'd say the macro overwhelms everything else. I mean, we are just in such a unusual period in terms of the massive amount of debt and money that's been pumped into the system over decades, and it's accelerated. Um, and I use the term super cycle to define even the bigger cycle than a secular cycle is that super cycle between two depressions. I think we could have a depression in the 2030s, and we had a depression in the 1930s. So that 100 years in between is the super cycle. So I think to some extent we're in the latter stages, the last 10 years of, say, a super cycle. And as a result of that, that kind of dominates, the macro dominates. But by no means do I think this pandemic is small or inconsequential. I think part of the bust, I didn't know it when I was talking about a bust before the pandemic, but the pandemic was really the trigger for the bust. Like I said, the debt and the excesses out there, we were going to have a bust no matter what. It was a matter of what was going to trigger it. I think the pandemic came along and did that. So it's definitely influencing the cycle and influencing my forecast. But I do think we come out the other side of it, and it's more macro that's going to be driving things. A lot of the inflation, the bust is going to create a huge response from the governments of the world and from the central banks of the world in terms of money. I've said before, I may have said it on our last interview, I think the Fed's balance sheet, which is currently a little over 7 trillion, can grow to, it will be above 20 trillion within probably a year to 18 months as a result of the bust. In other words, that will be what it will take, and it might even be as high as 30 trillion. That's what it will take to pull a free-falling financial system back out of that spin. And so that's what I mean by the macro overwhelms anything else. Is those numbers are just, we throw around trillions like it's no big deal, but to increase the balance sheet, the balance sheet in 2008 was only just over 850 billion, and we're now at 7 trillion, and I'm talking about it growing in the next 18 months to 20 to 30 trillion. I mean, those are numbers that just are mind-boggling, and I don't think we really, nobody can get their arms around that. I mean, it's a number that is just out there. So maybe I'll be wrong about the magnitude, but I think it's going to be big, and as a result, that will overwhelm. But make no mistake, the pandemic was part of the reason we have the bust, and so the response to that will be money, but the pandemic was playing a role.
It's very interesting. That's what, even though you're a contrarian and you're the opposite of what most people that I hear speak, on that point, everyone is almost in unison that we were headed for something huge simply because of the extraordinary money printing that was going on, all of the debt everywhere, that the only question was what would trigger it. So instead of the pandemic really changing anything, it turned into the trigger for what was coming anyway.
Yeah, I will be honest, though, I think most of those people saying that today were not saying that a year ago or 2 years ago. They're Johnny-come-latelys to this scenario. Yeah, they'll talk about it now as if they always saw it coming, but I was ridiculed tremendously for calling for a bust. I mean, it was not something that most people believed was coming. Now, there certainly was a crowd out there, a small crowd, particularly in the Austrian camp, that talked about this could be the end of it. As I say, the difference between me and the real gloom and doomers that we're talking about this is, we're coming to something that may end, be the end of it as we know it. In terms of the economy, and the long depression. The difference between me and them is I think we have this short bust, and then because the Fed will have Fed and central banks will have unlimited ability to print, we have one more cycle before you get to that real gloom and doom scenario. So So those people were out there, but a lot of other people have now joined the crowd in terms of saying, oh yeah, this was, we knew a bust was coming, or we knew.
I saw it though.
No, I don't think so.
I just want to nutshell this once for everyone. So what you see is we're doing great until maybe the third, fourth quarter, and then we're going to have a crash that's short-lived, maybe a year and a half, and then you see the Fed taking over, and we go very well throughout the rest of the decade. Something that you've talked about that kind of has me a little worried is after 2030, because then you see a legitimate reaction to everything we've done. That's when we really start to pay the price on this huge debt. And I just want you to talk about that a little bit.
Yeah, let me just clarify for this year, people need to separate stock market from economy. My stock market view is that we could top out sometime in the second quarter. It doesn't have to, it could extend, but my best guess is that we top out sometime in the second quarter. The economy, because the stock market typically leads the economy by many months, may not really start showing the reason the stock market is topping out until, say, fourth quarter. So I don't know that. It might start sooner, but I just want to separate those two. And so, yes, the stock market will begin a bear market once that top is in. And so you could have, a top April, May, June, and the stock market may still be okay and look strong until fourth quarter. So that can throw people off because they like to think of stocks and the economy as one and the same. So then beyond that, to try to wrap this up quickly, because I know you're on time constraints, beyond that, then we have a recovery cycle. I don't think the stock market gets back to its high. So let's say 4,600 is the high on the S&P. You can have a strong stock market in, say, 2022 to 2027 or 8, but it will be coming from that trough, let's say an 80% decline. I don't know whether it'll be 70 or 80%, but something big. So let's say we get to 4,600, then we have an 80% correction. That takes you down to, say, 1,000 on the S&P, or just below 1,000. You could have a tripling of the S&P from that trough, from the bottom of the bear market, and only be back to 3,000, right? And if we topped out at 4,600, your top in the next decade might be 3,000, 3,500. So a lower high, and that's what a secular bear is over several cycles: lower highs, lower lows. So that doesn't mean there's not going to be opportunities on the other side of the bust, but just understand, for somebody in an index fund, if that index fund goes, an S&P index fund goes to 4,600, they may never get back to that level again, right? So even though, from the bottom you do well, you may never get back to the level you get to in the first half of this year. So it's important for people to understand secular peaks means going forward, you may not revisit the highs. Once we get through the next decade, with inflation moving towards, high double digits, and interest rates moving towards high double digits, and a debt in the system that will even be higher. So if we're at 250 trillion now, we could be at 350 or 400 trillion by the end of the decade. How do you finance that? You can finance that when rates are 1 or 2%. How do you finance that if rates are at 10, 12, 14, 15%? You can't. I mean, the math doesn't work out. So at some point, the Fed, as well as other central banks, the governments are going to be at a point where they can't fund their debt. They can't keep piling on new debt. Which is really getting at MMT. This modern monetary theory where you can
They're
have your cake and eat
brilliant.
it too.
MMT. Just
Yeah,
keep printing.
yeah. You can spend government money all day long because you just float some more debt and pay for the to service the debt. That works when you have very low interest rates. It doesn't work when inflation takes over and all of a sudden rates are moving up very quickly. Our government, as well as the governments around the world, are going to run into a situation where they cannot fund their debt. They can't service it. And we're going to find out in this country, because we haven't for the last many, many decades, that when the Treasury can't just say, I'm going to float another bond, we need more money, when they can no longer go to the capital market because the capital market says, you're a bad risk, we're not buying your bonds anymore, all of a sudden our standard of living is going to plunge because we don't have anywhere to take from. There's no more just free money out there, and with interest rates and inflation towards the end of the decade way up, it really is much higher risk of something really unforeseen and an unwind that can lead to a true crash, where things just come tumbling down. And I don't pretend to know what comes on the other side of that, but I don't think it just doesn't look like you can solve that puzzle easily. And so I think many, many decades of borrowing leads to at least a decade or two of payback period where you operate at far, far below potential. So I think the 2030s and maybe beyond is a period that people are just going to have to get used to a lot less.
Wow.
But as I tell people really quick, focus on the here and now, because that's a forecast and it's a long-term forecast. And, don't lose sleep over something that's, may never happen. It's what I see right now, but, let's focus on the next several years, not, 10 years out.
Right. Because the next several years just look spectacular with everything that's happening. We never know what could change, but we do indeed have a problem with all the debt and what it's going to take to get us through it. So this is going to be very, very interesting, right? Where are you focused investment-wise? You said that wasn't where you were focused in green energy. Where are you focused? Precious metals?
Well, like I said, I can't provide advice, and talking about where I'm focused is a form of advice, so I stay away from that. But what I can say is, just from a forecasting standpoint, I think the precious metals, have a huge runway ahead. Commodities in general are going to be, I think, the leaders of the next cycle. So everything from ag commodities to metals to the steels and the rare earths and everything, I think you're going to see, and particularly energy, I think the period after the bust is going to be a commodity cycle like we've never seen. So I guess that tells you what I think of our next decade.
Wonderful. David, this has been an amazing interview. It's always spectacular to have you here. Please tell everyone where they can go to follow your work.
Sure. Probably the best thing is to follow me at Twitter. My handle is at Dave H. Contrarian. And if you are interested, I also do have a quarterly investment letter that I put out. It is by subscription, so there's a cost to it. But if people are interested in that, if they just go to Twitter and direct message me, I'll get back to them on the details of that.
Yes. Thank you so much for coming on this show today. This is going to be an amazing time, right, to watch.
Yeah, it definitely won't be boring, I don't think.
It won't be boring. Mr. David Hunter, investment professional, precious metals expert, and chief macro strategist at the Contrarian Macro Advisors. For the Industry Experts Panel, I'm Michelle Holliday at PortfolioWealthGlobal.com.